talk about the fair value reporting for equity method investments. And there is an example. It says, for example, top of page 23, firms using fair value accounting simply report the investment's fair value as an asset and changes in fair value as earnings. And they give you a to illustrate, which is the third paragraph on page 23. On January 1st, Westwind pays $722,000 in exchange for 40,000 common shares of Armco. They have 100,000 shares outstanding, so that would mean 40%. During the next 2 years, they report certain information, and they elect to use fair value accounting and make the following adjustments. So they are using, notice that there's dividend income. They are using the fair value, or we used to call it the cost method, but it's the fair value method, okay? Which means they do not have the ability to exercise significant influence. Otherwise, they'd be using the equity method of accounting. So hopefully you went through that, and so they're doing dividend income, but then look and see what they did. They recognize it as investment income, but then at the end, the third journal entry, to recognize the 40% change in fair value, and then again recognizing the next year's dividends, and then the change in fair value. So you need to make sure you can do that particular one. Let's practice. Let's do problem 4. It doesn't have numbers yet, but we want to go to problem 4. I'm on page 28. Under the fair value accounting of an equity investment, which of the following affects the income the investor recognizes from its ownership of the investee? And the answer is B, Boyd. Changes in the fair value of the investor's ownership shares of the investee. We saw that. They had 2 journal entries that did that, right? Okay, so the answer to 4 is B, Boy. All right, and if we go back to the outline, as a reminder, and this is just a summary of what that section is about, it says current financial reporting standards, it's on the screen, allow firms to elect to use fair value for any new investment in equity shares, including those where the equity method would otherwise apply. However, once that option is taken, it is irrevocable. Investee dividends and changes in fair value over time are recognized as income. So this is kind of a hybrid. Here we've got the cost or fair value method, then we've got the equity method. Now we have this fair value option. Once you choose, it's a done deal, the fair value option. And so they chose that. And they give a little bit of background. On February 14, 2013, the FASB issued a proposed accounting standards update entitled Recognition and Measurement of Financial Assets and Financial Liabilities. It would eliminate the fair value option for investments that qualify for equity method treatment. However, it would be extended to equity method investments that meet the criteria for classification as held for sale. So if they are equity methods, so in other words, there's a lot of flux right now about what, so make sure before you take the CPA exam, you know what is current GAAP. Right now there is the fair value option for equity method, but then notice it says on February 14th, they issued a proposed accounting standard. So we don't really know what's going to happen right there. But what if we do use the equity method? Following down on our outline, the investment account is adjusted to reflect all changes. You can kind of think of, other than that one exception, whether or not it stands, the cost method, we just record dividends as income, and our portfolio is has an evaluation allowance. Okay, but the equity method, everything affects the investment in stock. And specifically, the investment account is adjusted to reflect all changes in the equity of the investee company. So it kind of looks like our share of their stockholders' equity. How do you do that? B, income is accrued by the investor as soon as it's earned. So we call them on the phone. How much money did you earn? We earned $100,000. 40% of that is earned by us. Debit investment, credit investment, income, no cash. And the dividends are returned a return of the investment rather than a return on the investment. So let's go to problem 6. We'll also do number 14 here. And problem 6 says, page 29, on January 1st, Puckett paid $1.6 million for 50,000 shares of Harrison's Voting common stock, a 40% investment. So again, we're in between that 20 and 50%. Below 20, use the cost or fair value method. Above 50, obviously, use the equity method. No allocation to goodwill or other specific account was made, and we will talk about those as we come upon them. Significant influence is achieved, so they're using the equity method. They declared a $2 Harrison, which is what is that noise? Not bother me, something upstairs maybe, is achieved by this acquisition. They applied the equity method, declared a $2 per share dividend. Oh, it's outside, okay. During the year, reported net income of $560. What is the balance in the investment in Harrison account found in Puckett's financial records as of December 31st? Well, first of all, I'm going to do some journal entries on the board. I'm also going to take this a little further and do it. What if it wasn't the equity method? What if they didn't have the ability to exercise significant influence? Okay? And then we're going to do T accounts, and I want you to memorize the T accounts. Okay. So, journal entries for the equity method. Derek, would you do me a favor and make sure that I am still on camera as much as possible?
Yep,
Is the board on?
Mm-hmm.
Okay, good, thank you. Okay, so when we purchase or acquisition, debit to investment in whatever it is, okay? This is equity method. We're not gonna have that many of these, so we set up a separate general ledger account for this. Investment in A company, investment in B company. It's not the available for sale or the trading portfolio, all right? We have a separate account for each equity investment that we have. Okay? So it would be, in this case, investment in Harrison, all right? And a credit to cash or however we paid for it. And it says we paid $1.6 million. All right? Then it also says that Harrison declared a $2 per share dividend during the year. Well, we own 50,000 shares. Be careful. Sometimes they tell you we own 40% and all they have is 50,000. But it says we paid for 50,000. 50,000 is our 40%. Okay, do you understand the difference? 50,000 divided by 0.4 would be a different number, right? Whatever that is. So they could give you the total shares and then you multiply times 40% times $2. But our dividend is, obviously we got a check in the mail, we got a debit cash for $100,000. Under the equity method, remember there are two returns that we expect on a stock. You and I expect a return on the investment, the dividend, and a return of the investment. But under the equity method, a dividend is seen as a return of the investment rather than dividend income. So we're not crediting dividend income, we're crediting that investment account, this account.
So you take our amount and times it by 2?
50,000 times 2. Thank you. So we are on problem 6, Eric.
Right.
and, we're doing equity method journal entries. All right, at the end of the year, it says that Harrison reported net income of 560. Our share is 40% of that, which is $224,000. So again, investment is debited or credited, $224,000, and a credit to investment income. The investment is an asset. The investment income is a revenue. That's the first time we've had a revenue account. No expense accounts, okay? Just a revenue. So this is where we record our revenue. Is that clear? And it's $224,000. For the equity method, then, we have two accounts. I mean, we have cash and we have other accounts, but the two that we're concerned about are the investment in stock account, in this case, investment in Harrison, and the investment income account. Okay? So far, so good. We have an asset account, we have a revenue account. I'm going to post these journal entries to those two T accounts. Debit investment, 1.6 million. Actually, before I put the numbers in, I'm gonna tell you the words, because what I want you to memorize is the words. The purchase price, the dividend, and the investment, or the end of year income times our percent. And the dividends is our share, our percent. Our percent in this case is 40%. Are we good? Okay. The end of the year income would be Harrison's income times our 40%. Now I can post those 1.6 million, 100,000, 224,000. The answer to this particular problem is 1,724,000. 1,724,000. So the answer to the problem is B, is A, apple. But I want to take it a little further, okay? Because there's several things that they could have asked in this particular problem. They could have asked me, what is our share of income? And that is how much? What is our share of income? Let's post this. All we have is a 224. So our share of income is 224. Yes? They could have asked us, well, that's probably the questions that they would ask. Sometimes they ask you at the end of year 2. So you have to post the next year's dividends and the next year's our share of income, okay? We've also got other things that we're going to add to this, but for now, this is to be memorized. You add the purchase price, you add our share of income, you subtract our share of dividends, and that is the asset balance at the end of the year. The only thing that we've learned so far that might change that is impairment. If we had an impairment, a permanent impairment. We did that in intermediate, okay, back in chapter 17. Now, this is the equity method, but there's also the fair value or the cost method. So I'm going to do the journal entries for that. The fair value, also sometimes called the cost method. On the purchase date, we either debit, other than that one exception that where you can do that option if they keep that, we debit either AFS, which stands for available for sale portfolio, or trading, right? Depending on how long we plan to keep it and whether or not we can sell it, and credit cash. So told you that there was no ability to exercise significant influence, and they were not exercising the fair value option, we'd make that journal entry. Okay? On the day we get the cash, well, cash is cash, right? But instead of crediting an asset, that's when we credit our revenue account, dividend income. You remember doing this? In chapter 17 of intermediate. Okay? So that is, we would call it dividend income, but be careful in your book because sometimes they'll call it investment income. Just because it says investment income doesn't mean we're doing equity method. Just because it says dividend income doesn't mean we're doing fair value method. The key is the word income or revenue. When they're using revenue here, that is the fair value method. Because we see the dividend here as a return on the investment. We see it here as a return of the investment. It's taking some out of the asset, giving us back a piece of our 1.6 million. Here it's just a dividend on our 1.6 million. And then there is no journal entry at the end of the year. The journal entry would be for the entire portfolio. You'd have a valuation adjustment. If it's available for sale, it's an OCI thing. Remember? Debit or credit, adjustment to fair value, which is either a contra asset or an adjunct asset, and then credit or debit, OCI, other comprehensive income for unrealized gain or loss. If it's a trading, that same account for the contra asset or adjunct asset, but the unrealized gain or loss is an income statement item, and it does go on the income statement for trading. Kind of remember this? Kind of? Hopefully. Okay. So our fair value, we have either AFS or trading securities is our asset, as opposed to investment in Harrison here. It's a portfolio, not just a specifically identified stock. And we have dividend. We do have the purchase price, which is 1.6 million, but at the end of the year, it's still 1.6 million. And even if we do have a difference in fair value, it is a separate account for valuation of the portfolio, not of that stock. That stock stays in AFS or trading at 1.6 million. It doesn't change. So you see how it changes at least twice a year over here. It doesn't change here. And you see that over here, the income is not the 224. It's the cash. You could think of this kind of like this is like a cash basis. And this is kind of an accrual basis. Now you'll never see that in writing because that's not what it is. But I think of this as being, our share of income is based on the net income, accrual basis net income. So far so good. Okay. So I could ask you, what is the available for sale balance at the end of the year? 1.6 million. How much income if it was the fair value method? 100,000. How are we doing? Let's do number 14. On January 1st, 2015, page 30, Fisher Corporation paid $22.90 for 35% of outstanding voting stock of steel and appropriately applied the equity method. So now we know the first thing you do, which method are we using? And we know it's these two, not those two. That's your first step. Equity or fair value. And it says equity. Okay? Any excess of cost over steel's book value is attributed to goodwill. So let's talk a little bit about that. Why do we pay more for the stock? What is goodwill? Goodwill is paying more than fair value for the stock. Why on earth would we do that? What defines goodwill? Or can you give me an example of what would create goodwill? Why would I those shares of stock, then each one times its fair market value. Why would I do that?
Do you think they're gonna be worth more in the future?
Yeah, because I think they can generate more revenue than if I went out and bought all those assets myself, put them together in a different location with a different sales team, with a different reputation, whatever. It could be the CEO is fabulous. It could be the salespeople are great. It could be that they have a great reputation. They could be green and everybody wants the environmental thing, you know. Whatever the thing is, we believe that the parts together, the whole, can make more money than if we purchased each of those parts ourselves and did it over here. That's called goodwill. For some reason, we pay more money. And you remember in chapter 17 of the intermediate book, when we have goodwill, it's only when we buy it, and we're buying it here. That's the only time we can record goodwill. And when we do record goodwill, we measure it for impairment. It does not amortize. Remember that. So anything that is, when we buy another company, there are two reasons why we pay more. Number one, the book value doesn't equal fair market value. Like the building is undervalued, or the equipment is undervalued, or the inventory is overvalued, or the accounts receivable are overvalued or undervalued, or whatever. So once we make sure that we know the fair market value, not the cost, not the book value, but the cost of each asset, and we're still paying more money, that's goodwill. And what they tell us here is that we paid $22.90 and still, let's see, 35% appropriately applies the equity method for its investment. Any excess of cost was attributable to goodwill. Well, there is no goodwill amortization, so the investment will not be affected. Okay? If there's no impairment, there would be no, an impairment would have affected that, but they didn't tell us anything about impairing the goodwill. Okay. So the equity method, 2.29 goes here. 2.29 million. And then it says, during 2015, they reported 720 in net income. We own what percentage? 35. So we're going to multiply 35% times 720 and get 252,000. I want you to get used to, I want you to memorize these T accounts, and then I want you to get used to plugging the numbers into the puzzle. And it says, and a $100,000 other comprehensive income loss. So we've got that OCI is OCI income loss is 35,000. Okay, if this company had had a loss instead of income, it wouldn't have been over here. It would have been on the other side, right? Just opposite. This particular journal entry would be backwards. Credit investment, debit investment loss. And they do, and if we had an extraordinary loss, this would be debit extraordinary loss, investment loss, dash extraordinary. So any pieces of the puzzle are D, discontinued operations, or E, or in this case an OCI, keeps its character coming into the parent or the investor. So we don't just mush it together, that they earn 720 and take out 100 and make it 620 times 35%. We do the 720 times 35%, and then we do the 100,000 times 35% separately. Okay? And then also, they declare to pay 20,000 in dividends. Make sure whether that's 20,000 to us or 20,000 in total, and it's 20,000 in total this time, so 35% of that is 7. So far so good? And so the question is, what amount should they report as investment in steel on its December 31st balance sheet. That will be the net of these numbers, which is 2.5 million. I could have also asked you, what are they going to show on their income statement with regards to this investee? And that would be $252,000. What are they going to report in stockholders' equity for the investee? $35,000 OCI. And what amount should they report as equity in earnings on the income statement? That was the second question. And that would be the 252. Not the 252 minus 35 because it has a separate character. And it's not an income statement. OCI is on the balance sheet, right? How was that? Good? Okay. Let's keep going. Let's do problems 1 and 2. Just kind of, we didn't do those and I probably should have. Problem 1, page 28. When an investor uses the equity method, the investor's share of cash dividends is recorded as what? Here it is right here. You're going to memorize the journal entries as well. Right? Purchase, investment in whatever, right? And they're talking about this journal entry. Number 1 is D-Dog, a deduction from the investment account. It's an asset, crediting it makes it go down, deduction from the investment. Number 1, D-Dog. And then number 2, since most of you, hopefully all of you have read the chapter, which of the following does not indicate an investor company's ability to significantly influence an investee? Remembering that in this class, it's going to tell you whether or not they have, but in real life you're going to have to decide based on characteristics. You're going to have to look at stuff and decide, do we have the ability to exercise? And that will determine equity or fair value method. And the answer to 2 is B, boy. The investor owns 30%, but another owner holds the remaining 70%. So that would indicate that we don't have significant influence because somebody else controls, right? So the other 3 are indicators that we might have the ability to exercise significant influence. A, C, and D. So far, so good. Okay, back to our outline. We've talked about one of these special things, but special accounting procedures used in the application. A series of acquisitions we haven't talked about, and on page 14 they do that. This is very common. A lot of times a company will buy just a few shares and then a few more, and then all of a sudden they'll buy a bunch to get to 40% or something like that. It's not an unusual thing. And so obviously, you own 1% or 0.5%. Well, you're on the fair value method. You're doing those journal entries. Yes? And then you buy a few more and you're still like 12%. Well, that's below the 20. You're still fair value method. But at some point in time, you jump to, now we have the ability to exercise significant influence. So now what do we do? And that is here, number 2, at the point in time that the equity method becomes applicable because we have the ability to exercise significant influence, a retrospective adjustment is made. Because we would have been doing this method, and what we paid for it would still be there in the available for sale or trading. We would not have been doing that method, you see? And so what we would do is we'd have to go back and redo our T account as though we had been doing the equity method all along, but not on our new percent, just on our 1% or 7% or our 12%. But we would compute our share of income, our share of dividends, our share of income, our share of dividends for whatever percentage we had at the time. And we would compute the difference between what we are showing and what we would be showing. It's not that we made an error. but we want to retrospectively reflect the equity method for the percentage that we owned. Is that clear? Okay. And so that would go to, usually it's a debit to investment and credit to retained earnings. Because we would have, usually dividends are less than our share of income. Most companies don't pay out their full net income, right? And so in this case, here we have, it would be $124,000 would be the difference between what we did record and what we would have recorded under the equity method. That amount would have been our difference. Debit investment, credit retained earnings. And that would be not a correction of an error, but a retrospective adjustment to retained earnings. Retained earnings, as previously stated, adjustment to reflect equity method of investment, or a change to the equity method based upon blah, 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 restated retained earnings. Debit investment, credit retained earnings. Problem 3. It says, Cisc Company has owned 10% of Mouse for the past several years. It did not allow them to have significant influence, but now they bought another 30%. And they will be using the equity method, so what do? And the answer to number 3 is CCAP, a retrospective adjustment to restate all prior years presented using the equity method. So we would, if it just says past several years, so at least 3, I think several was at least 3, all right? So at least 3 times we do this and this and this and this and this and this at whatever, at the 10%. Okay? Okay?
You mean at 30%?
No, at the 10%. We only own 10%. And so it would be at what we owned. It would have been inappropriate to do that, but now it's not inappropriate anymore. Now we're going to use equity, so we retrospectively reflect that 10% ownership on the equity method. No, it's at the 10%. We good? All right, so we did that. Investee income from other than continuing operations. We did that OCI one here, but I'll read you the outline. It says the investor recognizes its share of investee reported other comprehensive income through the investment account. We did that. And the investor's own OCI, stockholders' equity. So part of the investor's stockholders' equity will include an OCI from the investee. And then also, I told you, part 2 there, that if it's an extraordinary gain or loss, a discontinued operations should be reported the same. It retains its same character for the investor that it did for the investee. If it's equity method, it's discontinued on the investee, then it's discontinued on the investor. Same place on the income statement. That was on page 15. Page 16 talks about losses, and I mentioned that. C1 says losses reported by the investee create corresponding losses for the investor. So again, this particular journal entry would be just backwards. Credit the debit, debit the credit. And we wouldn't call it investment income, we'd call it investment loss. And so it would affect, it'd be a credit here and a debit there.
So that's for investee loss, you said?
When the investee, instead of having net income for the year, they have a net loss.
Okay.
That's on page 16. Let's do problem 5. By the way, your test bank looks a lot like your end of chapter multiple choice and problems. Your test bank is not AICPA adapted. You don't have CPA type questions. Although the GLIME is still valuable. And they do key that Hoyle to the GLIME. Okay, so you can still use it. It's still very helpful in learning the material, but you won't have those tricky kind of questions. To me, these are very cut and dry, multiple choice. They're asking you most of the time one thing. Now, sometimes you have to do a couple of, computations, It's really only one concept most of the time. Does that make sense? You're gonna like this better than the intermediate test.
So for this test, this is like, isn't this gonna be like our final exam?
It is your final. For us, it's worth 150 points.
Will there be a chance for us to get the 20 points of extra credit after?
I will, no, you won't have a quiz after, and you won't have a quiz before, but I do sometimes curve it.
Okay.
I can't guarantee there'll be a 20-point, like we, normally an intermediate for the final exam, like in 3111, I just add the 20 points on. Because these questions are not as tricky, we don't often need a curve, but I retain the right to give a curve. And a lot of it would be, if 4 of the 6 of you missed one problem and you all put the same wrong answer, then I would just add those points. I wouldn't just throw the question out, I would just, because you've wasted time even if you got the right answer. So, and I will tell you that this particular text is not as well vetted, or better word, as your KISO. Intermediate Accounting KISO, that KISO book is worldwide, it's #1 in the world. There are a lot of people that take intermediate accounting that don't take advanced accounting. So the number of people that buy advanced accounting books is much smaller, therefore they don't spend as much time testing the material and reviewing. They don't have as much budget for reviewers, so there can be errors in their test bank. There can be errors in the book. You don't find very many errors in that intermediate book. You find more of them in this book. Does that make sense? So it's possible that you know, hopefully not. Hopefully they've corrected them by now, because this 12th edition is not new. It's not a brand new edition. All right, so let's go back to the book, page 24. What do you do when you sell an equity investment? That's on page 20. Maybe not. No, that's problem 24, sorry. Page 17. Page 17. So, they give you an example, as an example, 2/3 of the way down, page 17. As an example, assume that top owns 40% of the 100,000 shares of bottom, and they're using the equity method. Any excess is goodwill, so we're not amortizing that. We'll talk about that in a few minutes. Although these 40,000 shares were acquired some years ago, we've been doing the equity method, and so now, because of the debit, credit, that investment account is 320. So far, so good. Okay. On July 1st, they sell 10,000 of those shares. 10,000 of the 40,000. Again, the math is easy to screw up here, because you could say 10,000 of 100,000 is 10%. Yeah, but we're selling 10,000 of our 40%, which is 10,000 of 40,000. We're selling 25% of our investment, not 10%. Do you see the difference? So be careful. Those are the easiest errors, most common. And so we are selling, of that 320, we're selling a fourth. So you take a fourth of 320, that's 80,000, right? A fourth of 320 is 80,000. So you see the journal entry. First of all, also, normally this end of year, that's only done once a year. So the first thing, just like when we sold a plant asset, you got to depreciate it to date of sale. We need to get the income and the dividends. Well, the dividends should be there. They should have already taken that off. Okay, and they say on, no, that was 320,000 was January 1st, right? So anything that's happened this year between January 1st and July 1st is not part of that 320. So what they did then was they took the 320, which is not the purchase price, but the beginning of the year price. So far, so good. That's the January 1st, 320 for 40,000 shares. And it says that income of $70,000 for the first 6 months. Sometimes they'll say $140,000 for that year, earned ratably over the year. And you'd have to compute the 70. You have to think these things through. You can't just memorize formulas here. You memorize the T accounts, you memorize the journal entries, but you gotta do some thinking. So 70,000, our share is 40%, so that would be 28,000 would be added. Debit investment, credit investment income, 28,000, our share of the first 6 months, right? And it says they declared and paid cash dividends of 30,000, our share is 40%, that's a 12 here. And so our investment, so the first thing they did was they updated the 28 and the 12. And now we no longer have 320,000, it's 336,000. You do this math here? Everybody good with that? And we get 336. And we want to take a fourth of that and remove it. And the journal entry on the sale is debit cash, skip a line, credit investment, and in this case, it told us that we sold it for 110. Our investment is 1/4 of 336 is 84. And you plug loss or gain. This case we need a credit, it's a gain. And that journal entry is on page 18, Eric.
So where'd you get the 28 from again? I'm confused.
The 20,
On the first part.
this one,
Yeah.
it says that they had $70,000 of net income for the first 6 months.
Mhm.
We own 40% of that, it's 28.
Uh,
It's doing the same thing we normally do here, but we only do it once a year. But in the same way, when we sell a plant asset, we gotta depreciate it to its date of disposal. And so we are updating our share of income, our share of dividends to the date of disposal. By the way, we still own 30%. If we still have the ability to exercise influence, then we maintain the 336 minus the 84. And so we have whatever that is, 252. And then we'll keep going up and down with 30%. But if we've lost the ability to exercise significant influence, we do not do a retrospective adjustment. That just becomes the cost, the new, that stays there. And from that point on, 30% of dividends is income.
why would it be 30%?
Because we had 40%, but we sold 10 of our 40 shares, so now we're down to 30,000 of the 100,000, 30%.
Okay.
So at this point, do we still exercise significant influence? If so, we're doing these same entries, but at 30%. If not, we're doing those entries at 30%, but we're keeping the 252 as our cost of our asset. And it doesn't go up and down, but it doesn't have to retrospective. So retrospective is going from fair value to equity, but no retrospective going from equity to fair value. Cool? So problem 24 now. Page 33. Several years ago, Einstein bought 40% of Brooks. The equity method is appropriately applied. So all of a sudden you're focusing on those two journal entries. T accounts. And those journal entries. In your mind, and I would suggest on your test, if you're going to do a brain dump, put those two things, put all 4 T accounts, and then put your journal entries down without numbers. Okay. Just get an extra piece of paper and just do that right when you sit down. honestly, for that first chapter, memorizing all of that is probably worth 30 or 40% of that chapter's grade. So you just need to memorize it now, and have it done. It says the equity method is appropriately applied. On August 1st, they sold a portion. How do they compute the book value? And it doesn't give us numbers. How do they compute the book value of the investment to determine a gain or loss on the sale? And I will show you that you can go to, and are these on the portal? Chapter 1, 2, 3? Okay. So you can go and read, because they explain it verbally. So this is not being done, this is, instead of putting numbers like we just did, they're actually just explaining it, okay? The equity method must be applied up to the date of the sale, so from January 1st to August 1st. Therefore, bless you, the current year until August 1st, they reported an equity accrual, which is this journal entry, for the first 7 months of the year, and any dividends as a reduction, this journal entry for the first 7 months of the year, which establishes the value, the book value, this number, on August 1st. And then whatever portion is sold, we take that percentage and make sure you got the right percentage. In the last one, this was 25%, not 10%. 10% of the investee, but it's 25% of the investor's investment. Okay. Then in Part B, it says, how should they account for the investment after that? Well, subsequent, it says it depends on the influence retained post-sale. So as I told you, if they maintain the ability to exercise influence, the equity method is continued, but using the new, smaller ownership percentage. However, if they've lost that ability, they will use the fair value method from now on. Part C says if they retain only a 2% so that it holds virtually no influence, what figures appear in the investor's income statement for the current year? Well, first of all, you'd have a gain or loss. And then for the last 5 months of the year, you'd have dividend income. Right? The gain or loss, actually, and the investment income for the first 7 months of the year. So investment income, a gain or loss, and then from that point on, the dividends, 2% of the dividends is what they tell you. And then finally, if they retain only 2% so that virtually no influence is held, does the investor have to retroactively or retrospectively adjust? And the answer is no. You retrospective from fair value to equity, you do not retrospective from equity to fair value. Okay? I know I'm beating the horse, okay, the dead horse here, but boring is good. Boring means we got it. Okay, let's go back to page 9. Because sometimes we do pay more. So far, everything we've said is we paid more than the fair value per share. You see, because if I'm a corporation and I'm going to sell 1 or 2 shares, I'll sell, it goes for the going price. But if I'm selling a significant portion of my company, I'm not necessarily going to sell it for that same per share amount. Because I got to deal with this person. They have perhaps the ability to exercise significant influence. I'm going to charge a premium for that. I'm going to charge a premium to lose that influence that I have right now. Excuse me. Okay, so page 9, and actually, let's go to page 11. And I will show you on page 11, the second chart thingy is what I call a DDES. DDES, determination and distribution of excess schedule. Determination, I'm going to determine and distribute the extra, the premium. excess schedule. So, and it's not excess over fair value, it's excess over book value. So as you see this, you need to memorize that as well. You need to memorize the DDES. So, sorry Eric, but I'm going over here. I don't know if you can still see me. So we've got a DDES. The basic DDES is the purchase price minus the book value. Now that would be book value of our shares. So if we're not buying 100%, it'd be the book value of the investee times maybe we're buying 37%. Okay? So it'd be investee book value times our percent. And that equals the excess. The amount we're paying above book value. Hopefully you've read this already. And so what you have is, you've got the, you know that we're paying $90,000 to buy a 30% share of a company that's worth book value $200,000. So they did 90, 200 times 0.3, 60, and we are paying $30,000 more than book value. And remember I said there's two reasons for that. Number one, undervalued assets, or overvalued. And number two, goodwill. Number one, under or overvalued assets. Number two, goodwill. So the first thing we're going to do is distribute that excess to those things we do know. Goodwill is an unidentifiable asset. We can't put our finger on what the goodwill is. Goodwill is the unidentified. It's an inseparable asset. It's attached to the company, right? But in this particular one, it told us that the equipment is on the books undervalued $60,000. But we're not willing to pay for all $60,000, only our share. So we distribute, and that could be equipment, it could be land, it could be accounts receivable or inventory, any assets, any liabilities are under or overvalued. Okay? And I would suggest you put, this is $60,000, but we're only going to pay for our $18,000. So if an asset is undervalued, in this case it is, this is a positive number. If an asset is overvalued, this would be a negative number. But if a liability is overvalued, it would be a negative number, right? The opposite of an overvalued asset. If a liability is undervalued, it would be a positive number. Okay? One more time. Undervalued assets, positive. Overvalued assets, negative. And the opposite for liabilities. Undervalued liabilities, negative. Overvalued liabilities, positive. And we make a list of them, and they did. Equipment and a patent. Perhaps we developed this patent, and so it's not at its fair value, but it has a value to us, like the Coca-Cola recipe, right? Okay? And so, in this case, it was those two, equipment and patent, $40,000, both of them undervalued. So, we have fully explained the excess with the undervalued assets. So there is no goodwill. So far so good, because there's another part to this. Any questions so far? Okay. That equipment, they tell us somewhere. Equipment, they have to give us a life for the equipment. One step further, assume that Chico's owners reject grants proposed price, well, I'm not gonna do that. The amortization process is on the next page, sorry. Okay, so notice that the equipment, they tell you, the equipment that is undervalued has a 10-year life. All right? Now think about this. I don't know, well, it says that the equipment is on the books. It doesn't even tell us. It doesn't tell us. Let's assume, let's just pick some numbers out of the air. Let's assume that the equipment has a book value of $100,000, but it's worth $160,000. Can we do that? It says it's undervalued by 60. So let's just pick numbers out of the air and say its book value is 100, but its value is 160. What is the investee going to continue to do? They're going to depreciate that 100,000. And that 100,000 with a 10-year life is going to be $10,000 of depreciation every year, right? But we know, and we've recorded it at our share of 160,000. And that 60,000 is also going to depreciate. Does that make sense? Which means part of our purchase price, part of the 90,000 is going away in 10 years. How much? 18. Needs to depreciate. We call it amortization because it's not our asset. It's the amortization of this purchase price. Okay? So what we do is we go out to the side. So I'm going to move my 30 down here and say 0 goodwill. 18 divided by 10 is $1,800 a year. 12 divided by what was the life on the patent?
5.
5 is 2.4,
2,400. Yeah.
which is a total of 4.2. So each year, for the first 5 years, $4,200 of that 90,000 needs to go down. You following? Any questions about that? In year 6, it's just $1,800. So we have another journal entry. I'm going to remove the sale because we're through with the sale now. That's only if you had a sale of part or all. But we do have, end of year, a second journal entry to record that expense. This is an amortization expense. It is always an expense. I don't use that term very lightly or very often, right? It's always. So instead of calling it debit investment expense, we just remove some of the investment income. So it's an opposite of this. Okay? Investment income for $4,200 and investment for $4,200. And that means our annual amortization, I forgot to put this up here. Our share of net income goes in the investment income, right? You need to add that to that T account, sorry. Add that to the T account as you're memorizing. So that we have, and this is not 30% of 4,200 because we've already done the 30%. We already multiplied, 100% would be 6,000 for this and 5,000 for that, be 11,000. You see? We've already multiplied it by 30% to get 18 to start with. So it is the amount. Because somebody else may buy it may buy 30% more next year, and the equipment could be now undervalued by 70,000. And so they're going to be having a different schedule. This is our schedule. This is the investor's DDES with the amortization to the side. I don't do it in 2 schedules because then you have to write everything twice. I just add it out to the right side. And you can do it all in one schedule. A DDES, determination and distribution of excess schedule. We determine the excess, we distribute it, and the rest is goodwill measured from parent. How we doing? Is it coming clearer than you were reading, I hope? So let's do problem 7, 8, 9, 13, 17, 18, 22. 7 is the first one. Problem 7. Page 29. Says in January 2014, Domingo acquired 20% of Martes Incorporated for $700. And it gave it the ability to exercise significant influence. Therefore, the method is equity. Okay? The assets on that day, Martes assets, this is the total company, we only bought 20%, were $3.9 million with liabilities of $900. So that would be net assets, aka book value, aka stockholders' equity, right? Are those not synonymous terms? Book value equals net assets, assets minus liabilities, equals assets minus liabilities, equals stockholders' equity. Those are all 4 different ways of saying the same thing. And sometimes they'll give you book value. Sometimes, like this one, they'll give you assets and liabilities. Sometimes they'll tell you the stockholders' equity section. Sometimes they will tell you net assets. Those are synonymous terms. Memorize the fact that they're synonymous terms. Don't say, oh, I can't figure it out. They don't have. You do. They just call it different things. So they can give you common stock, APIC, retained earnings, treasury stock. And as long as you minus out the treasury stock, you've got net assets, you've got book value. Okay? However they do it. So in this case, let's do our DDES. The purchase price, how much did they pay? $700,000. The book value is?
Oh, the 3 million.
So it's 3.9 minus 900, which is 3 million. 3 million. 3.9 million minus 900,000 is 3 million. I just couldn't figure out where you were getting that. And we bought 20%, which is 600. Now, hopefully you would see, if you put 3 million there, you'd say, something's wrong with this picture. I mean, that makes no sense that we would get that big a bargain, right? Bless you. And that's because we didn't buy all of it. This is our price. This is our book value. Our price, our book value. So far, so good. So our excess we determined to be $100,000. Let's keep reading. It says the assets were recorded at $3,000,009, liabilities $900. Any excess was attributed to a patent, a useful life of 10 years. So they kind of made it a little bit classroom here. Okay? So all of it was patent. And so that makes goodwill nothing. Yes? Divided by 10 years, that's a 0, is $10,000 amortization per year. So far, so good. You need a minute? Who needs a minute?
What
Okay.
would you do with the patent again? So
Well, it says all of the excess, any excess, was attributed to a patent. So I gave it all there, making 0 goodwill. So I plugged the 100,000. Then it also tells me that the patent has a 10-year life. So I went out to the side and did a $10,000 for each of 10 years. We're going to have a $10,000 amortization. Are we back on? Any questions at all? Okay. So step number 1 in all of these problems, determine whether you're using equity or fair value, so that you can, in your mind or on paper, put the T accounts and the journal entries down. Number 2, do a DDES. That is step 2, do a DDES. Okay?
So one's journal entries, two's DDES.
Well, this journal entry will use the DDES, right? One is T accounts and journal entries, knowing the accounts. Step 2 is the DDES. Then step 3 would be completing the journal entries. Step 4 would be posting to the T accounts. That's how you solve every one of these problems in this chapter. Okay? That's why we memorize the DDES. We memorize the journal entries, and we memorize the T accounts. Okay. So do we need a minute? Eric, you okay?
Yeah, we,
Okay, so the next paragraph says, in 2014, they reported net income, and the next year they reported more net income, they had dividends each year. So what is the equity method balance at the end of year 2? So what we've got then is we're gonna put our purchase price in. Our purchase price was how much? We gotta pick the pieces of the puzzle.
700,000.
So we put 700 here, that would be this journal entry, 700. And then it says 70,000, it says Marta's dividends were 70,000 each. We don't own all 70,000,
Should be 70,000 times 20%.
which is, 7 times 2 is,
14.
so it would be 14, right? Which does not affect it here. That was cash, debit cash. Okay? The most common error is people want to put dividends in here and they don't go in here. The most common error is putting dividends here. Don't. Memorize the words, and you don't see dividends, don't put it there. Okay? And then it says, end of year income, it says the first year they had,
170,000.
170, our share is 20%, 17 times 2 is 34. That would be this journal entry. And then that journal entry for each of these 2 years is, go out to the side, 10. So 34 and 10, 10, right? That would be year 1. And then we would close that $24,000 to retained earnings. Investment income's a revenue, we close revenues, they go to 0. We're clear there? Okay, so we close it, starts the new year. The new year, we have another 14, another 10, and then this is 210 times 20% or 42. That's the number you want. We also have, for that year, we have 42 and 10. So they could ask us, how much income, how much investment income? 32. How much investment income for the first year? 24. What is the balance at the end of the first year? We didn't subtotal that, but we could. What's the balance at the end of year 2? And the answer is 728. Which is A apple. That was their 170,000 times our 20%. End of year income, 170, our percent, 20. So memorize those, end of year. And here it was end of year 210 times our 20%. The amortization, DDES. Purchase price at the top of the DDES also given. So can you plug the numbers in? That's really all the chapter is trying to get you to do. Can you do the journal entries? Can you plug them into the T accounts? Franklin buys 40% of Johnson for $500,000. Although they didn't use it, it gave them the ability to apply significant influence. Therefore, the method is equity. Okay, they report assets on the date of 1.4 million, liabilities of 500,000. So, step 2, DES. How much did they spend? 500,000 is your purchase price. Oops, that is amortization. Okay, so 500,000 would go in this journal entry. They report assets of 1.4 million, liabilities of 500, which is a book value of 14 minus 5 is 900,000. We bought what share? 40.4?
Yeah.
9 times 4 is 36. Our excess is 140. So far, so good. Can you do this? Okay. Then it says, one building with a 7-year remaining life is undervalued by 140. Okay. So we got building, undervalues, that's a positive number, by 140, I think, times, we bought 40% of that, is 56. Also, the book value for the trademark with a 10-year life, it is undervalued by 210. Assets undervalued, trademark 210.4. Okay, so far so good? Any excess is attributed to a patent with a 10-year life, so again, they didn't want you to have a goodwill. So I know that this is 140, so the patent I'm plugging to get 140, right? So 0 goodwill. So far so good. And what is that number? I got 98, so 42, am I 42? Okay, and now let's do the right side. Let's do the amortization part. It tells us 7-year, 10-year, and undervalued by, no. A building for 7, help me here. Book value for its trademark is 10. Did it tell me there was, did I read that or did I not read that? I think I skipped to a different problem. Book value for trademark is undervalued during the year. Oh, they did not tell me that. I think I went back to the last problem. Sorry. Okay, if that's the case, sorry, scratch it out. This is 98. So I do have goodwill this time. Sorry.
How'd you get the trademark? I think that's calculation.
210, it says it's undervalued by 210.
No, but it said 84. That's cool.
Oh, you're right, 84. Okay, I would say that I wanted to see if you were on your toes, but that would be a lie. Ah, now it's 140, so we have 0 goodwill. Oh, look at that. I figured they would do that. I didn't think they were throwing goodwill at you so far. So thank you. Thanks for correcting that.
So if you had goodwill, would you have to?
All you do is measure it for impairment.
Okay.
And that would be the same journal entry here, but it would be impairment loss. Okay, so this was a 7-year life, and this was a 10-year life. Does that look better? right up there. They always do the DDS in a different order. You know how books do that, and I always do it in the same order. So if you memorize the same thing and know that undervalued assets are positive. Undervalued assets are positive. Undervalued assets are positive. Okay? So now we can plug our numbers in. 500. I'm going to take out this OCI thing because your typical is just that, right? All right, and it says, in this year, Johnson reported net income of 90, of which we own what percent? In the year 90, our share 40%, 9 times 4 is, and they pay dividends, or declare dividends, and we record them as they are declared because that is a receivable. Dividends of 30. 30 times our 40 is 12. 3 times 4 is 12. And then we have amortization. $16.844. 16.4. And so you get 507,600. That is the answer, which is B boy. If they'd asked you for this, which they didn't, it would have been 19.6. We're getting better. It's starting to come through a little bit. We're going to keep going until it's there. Number 9 says, Evan reports net income of $140 each year, declares an annual cash dividend of $50. The company holds net assets of $1.2 million. So you see, this time they used net assets rather than giving us assets minus liabilities. On that date, Shalina buys 40% for $600, giving it the ability to significantly influence. Step 1, which method? Step 2, DDES. Let's do it. They pay how much? 600. Boring is good. Let's all get bored. They paid 600. Their book value, their net assets was 1.2 million, I believe. We bought 40%, which is 48. 120 is our excess. We have determined our excess to be 120. On that date, let's see, at the purchase date, the excess was assigned to goodwill. So we didn't have any undervalued or overvalued assets or liabilities. Okay? You could say minus 0, and that gives you 120 goodwill. And they ask you, what is the investment in Evan Company balance? That's this one rather than investment income. At December 31st, 2016. So, purchase price, 600. It says for the year they earned net income of 140 times 40% is 64, is that right? 13, 4, 6, 56, sorry. 56. Your dividends, it says dividend of 50, 40% is ours. Dividend 50%, 20, 40, 20, and then amortization, none. Okay, so 636. Oh, and then but they're asking you for 3 years later, so. So what they did was 56, 20, 56, 20, 56, 20. See it over there? Each year, how how convenient that they have exactly the same net income for 3 years in a row and they pay the same dividends 3 years in a row. Isn't that classroom? Right?
Where'd you get the 56 in?
Net income says is 140,
Okay.
our percent is 40. So the answer to number 9 is D dog 708. They just don't do the T account, they just do a schedule, you know how the book does that. 7, 8, 9, 13. Are you ready to go solo? You ready to try one by yourself? If I write it on the board and be quiet? Okay, so number 13, page 30, they're asking you, at the end of the first year, see the January 3rd, 2015 and the December 31st, 2015, it's only 1 year. And there is the ability to exercise significant influence, so we know it's equity method, so we're gonna do a DDES. Okay. Also notice in this particular one, they tell you book value, but not of the whole company. They tell you the book value of the acquired shares. They've already multiplied it by the percent.
Oh, so that's on.
So just be careful, you know, apples to apples, right? By the way, I'm gonna give you an extra day on your homework. Somebody send me an email and I'll change that due date. I'd rather, finish the problems that we have for today, and there's the, intercompany sales of inventory. We will start today, but we will not finish till next time. We have 3 days on chapter 2. We need 2.5 on it. So, since we spent a lot of our time in the first day of this chapter going over the test and then doing the quiz.
So it'll be due next class at the Thursday.
It'll be,
It's due
instead of it being due
tomorrow. It would be due.
tomorrow,
Did you do Thursday night?
it'll be due Monday night.
Monday night?
So somebody send me an email, please, that, and I'll just change the date. It doesn't mean you have to wait until Monday to do it, Thank you, 5 minutes. Is that right? Ah, it's because that clock is wrong.
Yeah, it's way off.
Yeah, I know, and I've been looking at it instead of my watch. I noticed that when I came in, but I had forgotten.
And then you just said we were gonna start something new, and I was thinking.
No, but if I had,
Yeah, if we had that time, maybe.
yeah, okay. Bad clock.
I was like,
So we will do the unrealized gross profit and inventory, do that next time. It's a really interesting concept. So did everybody get this? 1,210,000?
End of the year, if they'd have told you that Matson Corporation had reported negative income of 260, you wouldn't have the times or anything like that would be their 40%.
If they said on,
Or would they always,
that doesn't give me.
will they ever give you the end of the year for
Sometimes.
that person?
Sometimes
So
they
on the
will.
computer percentage
Matson share, or 40% of the net income for the year is.
is 2, okay.
So you just have to think about, do I need to multiply it by 1% or not? Did you get it? Eric got it? Derek?
So that's just for 2014, right? Because if you were to do 2015, you'd have to.
You'd have to do
add another income, right? Go
income,
down.
another dividend, another amortization.
When it's the same number, you just do it.
You just go down.
So it's starting to come through, right?
So
We're
you want
doing
to
it in
do 1 plus 104 minus, okay.
every year, income, dividend, amortization, income, dividend, amortization. So far, so good. Number 17, 18, and 22 we will not get to, but I will show you 17 and the answer. I highly recommend that you do 17, 18, and 22 on your own. Spend an hour, do those 3 problems. 17 is asking you for journal entries.
17, 18, and 22.
17, 18, 22. I know all of you want to do very well on this final exam, which is way easier than the other 3 exams. So, says number 17, I'm just reading to you. On January 1st, Alamar acquired a 40% interest in Burke's for $210. On that date, the balance sheet disclosed net assets with a fair and book value of $360, which means if we have an excess, it's goodwill. Because the fair value, everything is valued fairly, right? No undervaluations, no overvaluations. That's what that's telling you. They reported net income of 80, declared and paid cash dividends of 25. They sold inventory. We're going to do that next time, but everything else we can do the journal entries. So it says 40%. We assume it is significant influence. Therefore, step number 1, equity method. Step number 2, a DDES. They have it up there for you. The purchase price, the book value of our share.
It says 10 minutes. What does that mean?
Should take about 10 minutes.
Should take you 10 minutes to do it. Well, double that.
Yeah.
And then they've got the journal entries. So they did this journal entry. They did Well, you can just skip through and just do cash and investment for dividends, but they did dividend receivable investment, cash dividend receivable. Okay, they made it 2 journal entries. Then they did